Hi everyone, thank you for joining us today for our webinar, The Ultimate Beginner's Guide to Credit. My name is Kelly Blount and I'm the Program Marketing Specialist here at General Electric Credit Union. We're so glad you've joined us as we have a lot of great content ahead. Thanks to technology, we're excited to be able to connect with you on such an important topic and wanted to thank you all for tuning in from the comfort of your home, work, or wherever you're joining from today. And with that, I'm going to turn this over to Rob Rower to introduce himself and today's guest speaker.
Good afternoon, everyone. Hi, my name's Rob Rower. I'm the branch manager at the South Lebanon GECU. Just want to give you a quick background on myself. 25 plus years in the industry, and just really happy to have you on here. So again, want to welcome everyone in attendance today for the Ultimate Beginner's Guide to Credit webinar, and introduce Todd Moore, who is the Director of Education from Trinity Debt Management.
Great, good evening. Thank you so much everyone for joining this afternoon. Great to be back with General Electric Credit Union, and thank you so much, Kelly and Rob. Today, great topic as we get started heading into spring. We think about some of these larger financial goals that we may have in this coming year. Think about home ownership, or maybe purchasing a new car, or just maybe thinking about ways to improve your overall credit capacity in this new year. Great topic today, the Ultimate Beginner's Guide to Credit Scoring and Building Credit. We've got really so much packed into this next 50 minutes. And I think we've got a great team today that can really provide great content and answer specific questions about what the credit union can do in helping you build credit, and also helping you establish lines of credit through the credit union. So let's get started. When we think about credit and its financial implications, for many of us that are new to credit, we certainly know sometimes that feeling when we've either been rejected through a credit score, or just maybe we see our current credit score and we think, wow, how am I going to overcome this obstacle? Today's presentation is really about making credit an asset. That is, this will open so many doors for you, being able to raise your credit capacity. Again, get a new home. Think about, a new car. Some folks may have aspirations to become first-time entrepreneur. All of these things lead back, really, they follow kind of one road, and that is we've got to have a great score. We've got to have a score that can get us a loan, and we want to remove all barriers along the way. And we've got the folks through the credit union where we can provide the education and counseling, and also the financial tools that you need through a loan and through the expertise at the credit union. So I appreciate everyone joining us today. Now, when we remove these barriers, I talk here in this first slide about just getting beyond. I want us to really think for a moment, just open our minds up for a moment beyond just monthly minimum payments. Oftentimes when we think about credit, we think about building a line of credit. Maybe we've become overextended. We're trying to raise our score, and then we get stuck maybe with monthly minimum payments. We start to see that some parts of our other our personal finances also suffer. So we have less money to invest. We have less money for our emergency savings, those sorts of things. So we're going to try today to have a conversation that really gets us started off in this nice spring weather that we're hoping is on the way, where you can really plan for some of these bigger life events that are coming in this coming year. And hope to provide that information to you today. So when we think about the ultimate guide to really learning about credit, I wanted us to take a step back for just a moment and just think about the evolution of the consumer credit market. Now, if you look back historically, credit early on starts with just, really through a personal relationship. So you would have, at the beginning of the 20th century, you'd have folks, this small business folks that are operating, and they extend these lines within their community. We don't really have a credit scoring model at that point. So when we think about where we're at today with multiple credit bureaus, multiple credit scoring systems, and bankruptcy scores and insurance scores and all these other kind of scores that sometimes we wonder about, this kind of places us in a context of just kind of understand the historic evolution of the consumer credit market. We've come a long way in those early relationships, as folks use credit more to purchase items and finance things through time, whether it's on a personal level or for business lines of credit, we essentially go from a point where we really start to think about risk as a business opportunity. And when we think about what I mean there is we have to find some way for folks looking at a credit market to say, how do we evaluate those who will, how are we going to get repaid? How do we know that someone that I loan money to or provide services to will actually pay us back? So folks begin to look at this notion of risk. It's been with us for a very long time, evaluating risk. When we think about credit scoring, I want you to think about credit scoring and just think about credit in itself as the risk that's involved from a lender's perspective. And, just think about that relationship where you're asking for services or you're asking for funds and then having to find a way to really evaluate how do we determine whether or not that this is going to be repaid. And what happens is the consumer market really evolves and it goes from a small business line of credit, just built on personal trust, to we start really modeling behavior. We start looking at how folks behave. That is, whether or not we're repaid, their debt level, their income, how those factors kind of come about. And that leads us really into this notion about regional credit bureaus. Before we get to the national level, with the three major bureaus that we have today, folks start in a regional basis and they start to look at models that would predict how folks utilize credit in regional markets. And then as the market continues to expand, we start to look really at the post-World War II era. And this is where folks are coming back from World War II and we're looking at things like refrigerators and new cars and those sorts of things. And we're finding credit being used more and more to finance. I mean, at one time you could purchase a home out of a Sears catalog. That always blows my mind when I see that. But it's really interesting to look at the evolution of the consumer market, because here's where we find post-World War II America in this period where we're mass purchases and cars, refrigerators, all these new things that are coming into the market as well. And a new thing called a master charge, utilizing a credit card and how that would function. It leads us to the place where we actually have to start looking at things on a national level and have models that can predict whether or not, again, I say behavior, but that's how we interact with credit. How do we use credit, whether we repay, whether we're late, all those sorts of things. So this slide really takes some time and just kind of think through the evolution of the consumer credit market and how it's evolved from really just relationships on a very small level to where we're at today, and how credit is used today, and why we need consumer credit models to be able to predict risk, and how you can understand the model to improve your overall personal finances, which is what we'll be talking about today. Also, sometimes for those who are new to credit, I wanted to provide just a little of the legal landscape, because oftentimes through my work with folks here at Trinity Debt Management, sometimes folks will say, I feel like the market works against me. And I want to clear a few things up when I hear that. It always puts me on guard, because those of us that are working in financial services, or those of us within the credit industry, we really want folks to understand that we are here to help, and that there is a legal landscape that is there to help you as well. So I won't spend a great deal of time on this, but as we think about just the context for today's presentation and really being savvy about how we look at credit, want to clear up some misperceptions. There is a great deal of work that has gone into making certain that things are fair and accurate and timely. So I've spent a little bit of time looking at how consumer credit reports function and why these laws are important and important to you. And this really goes back to this period of 1970s. So if you think about that evolution of the consumer market, we go from very small relationships to where we're starting to look at things on a national scale. There's also been in the 1970s, as it was a period where we really start to look at consumerism and consumer protection. And part of that in the 1970s that comes out of that period of time is the Fair Credit Reporting Act. So really holding folks accountable within the credit realm for having things that are timely and and accurate on credit reports. In other words, providing a legal landscape that protects you as a consumer. So when you think about, just your overall credit and how credit functions, just be assured that there are, when we look at credit unions, we look at nonprofits, or anyone who interacts in the credit market, that there are laws and that there is an industry that is heavily regulated and protected for you, the consumer. And at the end of the day, these laws work to provide accuracy and making certain that we provide a way to help you improve. That's the key difference. We want to help you improve. So a couple highlights from the Fair Credit Reporting Act. It's been amended many, many times, but these are things that as you're new to credit, you'll see these, particularly when it comes to credit reports. I wanted to spend a few minutes on just a couple items here that you might see. Oftentimes when you think about a credit report, again, place this in the context of a law. So you have rights that are under the Fair Credit Reporting Act. So multiple examples that are provided here on this slide, but again, going back, there's a long history. So you pull a credit report, you want to make certain that the information is up to date. You want to make certain that you have the ability to dispute items that are incorrect. There's numerous changes to the law since the 1970s that really protects you. So if you go through time, you can see where the Fair and Accurate Credit Transaction Act in 2003. That was a big change in the law itself. Credit score disclosures. This comes out of 2011, where there was a new disclosure box placed on a credit report, enhanced protections for security freeze and fraud alerts. Again, placing this in context. So when you see a credit report, kind of understand a little bit about the history and the law that supports you and protects you through the credit market. So let's get into really what I call a framework for credit scoring. And this was a model that I picked up from Credit Builders Alliance out of Chicago, which does a lot of work in the credit area and works with a lot of all the major banks and credit unions in the country. And I thought this would be great to share this with you. And, it really is made up of 5 essential steps. And we'll be talking about these 5 key areas today, but consider the goal, and this will be looking at your overall credit goal, learning about the credit score, knowing how to get the good stuff going, and we'll share some really good insight there. That again is that relationship, and I want to encourage folks that are on the call today to really understand that relationship truly does matter between you as a consumer or a borrower and General Electric Credit Union. Products and services, get the good stuff going. Dealing with debt, I certainly can be your partner there along with the credit union to deal with any kind of outstanding debt, to make certain that we get you a score that will open the doors for you for home ownership or whatever those larger goals may be, and then continuing to make credit building function. So we'll be talking about that throughout the duration of our call today. And please, again, if you have questions as we go along, save those questions till the end. And between me and Rob, we will certainly answer any questions that you have. So one of the great things today is that we're working with General Electric Credit Union, where we have access to folks that can really help us when we think about considering what our goals actually are. So I'm going to encourage you, as you think about why you're on the call today and learning about the Ultimate Beginner's Guide to Credit, what is that? What is the goal? What is it that's motivated you today? And here I want to ask you, what are your credit needs? I've mentioned several examples, whether it be a car loan, home ownership, a personal line of credit. Maybe you're thinking about becoming an entrepreneur. Those are things that I hear routinely in the work that I do. But you need to answer that question. What is it that motivates you? What is it? What are your credit needs? And then you also have to ask, what is that minimum score that's going to take that I need to qualify for that particular line of credit, whether it's car loan, home ownership, personal lines. When we think about credit and you think about becoming savvy as a beginner or doing some additional work in credit, we have to start to adopt we have to approach it in the correct way. So you might want to ask these types of questions. What is the minimum score that will be required for that particular line? And you always want to work directly with General Electric Credit Union to ask those questions. Pick up the phone and talk to a loan officer, call and speak with Rob, ask some questions, so we can align your goals and your current credit score, your credit needs, and align that with whether it needs to be through debt reduction or help you get a score, establish your score, those sorts of things. So we can work with you, but we need to know what is the goal, and encourage you to kind of think about that today. And we've got a team that can really work with you whether your score is lower. We can help you along the way to really establish a score or maybe reduce debts, provide credit building strategies. But at the end of the day, we want to know the goal and work with folks so we can establish a timeline. And that's where I have this in step 3 of our action steps, to really establish a timeline for whether we need to build credit or strengthen credit along the way. At the end of the day, again, our goal is to make certain that you get a loan and that your larger personal finances are improved. But we need to take this initial step, write down what your credit needs are, and then we think about what products and services, that is, what types of loan products or what type of services, debt reduction, et cetera, that we need to reach that goal. Second thing I would encourage you to do is, obviously today we're learning about scoring, but really take some time, even after the presentation, go back and review some of these credit scoring factors. I'll present those here in a few minutes, but the more you know about scoring and you start to apply this model, the more you become savvy and understand how scoring works, and you'll see how it fluctuates through time as well. But as you know the score, this is where, again, your knowledge about the credit scoring process and credit generally is going to help you not only keep your score strong through time, but I always talk a lot about behavior, but also it kind of raises questions whenever we think about maybe overspending and how it will influence our larger personal finances. We just don't want to get ourselves too far in debt, and having a strong background in scoring and just knowing how it functions, I think it oftentimes puts us on guard and changes behavior. So knowing the score not only opens our opportunities in terms of getting lines of credit, but I also think that it helps us in our personal finances broadly, because we reduce debts through time and really take time to think about other parts of personal finance, whether it be paying down student loans, et cetera. So learn as much as you can through the webinars that are provided through the credit union to continue to know more about scoring and how it impacts personal finances. So when we think about scores today, what we're going to be looking at, we'll look primarily at the Equifax score. You'll notice here in the first bullet point that we've got 3 major bureaus that collect information. Those are those national credit bureaus that I talked about early on, and they each will generate scores, but we'll focus today on the Equifax score, which really runs from 300 to 850, and then I'll introduce what those factors look like and explain to you how the scoring model functions. Again, a little background on that. Fair Isaac, FICO. I mean, this goes back again to that period of post-war where we're really building a model, and this has been a consistent model. And I've noted here that this is for folks. I often get a lot of questions about, which one of these scores should I be looking at when I think about a home loan. I often focus on the Equifax score, but you will certainly, with the credit union, they will give you some additional guidance. But I think if you understand how the FICO model works, you'll see that relationship and how the rationale works between all 3 models. So we'll talk pretty much exclusively about the FICO Equifax score today, or what we refer to as the Beacon score. Now, I will caution you about the Vantage score, and I'll introduce that to you here in a few minutes, but folks will say, well, I've used my Credit Karma score, which is generated as a Vantage score. I'll show you the distinctions between those two and why I lean so heavily on looking at the Equifax score and the distinction between these models and how they work. So when we know the score, One point that I will make there is, as you will see in the next couple slides, we want to be able to differentiate between what we consider to be a Vantage score and really the Equifax score. So when we think about these various approaches, now FICO generates a lot of different scores, okay? And in fact, not to overly confuse everyone on the call today, but FICO does generate a Vantage score. Well, it's different than the score that we'll be talking about today. You'll see a lot of the same factors, but here's the fundamental difference, okay? If you look in the slide itself, FICO, all three major credit bureaus are going to rely on the score, and we know that its implications are, the scoring implications are used for all types of decision making, that is auto, mortgage, personal lines of credit, etc. The difference here is that where a lender will use a credit score generated by the major bureaus for a lending decision. That's not the case when we look at a Vantage score. The Vantage score, as you notice on the slide, this is for educational purposes. And I can't give you a full description of how that model internally functions because those are trade secrets. I don't think anyone really knows that outside maybe some of the folks that work within the industry at FICO. But basically what we have is we have an understanding of the model. But the key difference for us and those on the call, just differentiate between these two approaches. The Vantage score, often referred to as a Credit Karma score, there's a pretty wide swing in the score. And so folks oftentimes will say, well, you know, I pulled my Vantage score and it's X. Well, that's really what I'm hoping to change in this ultimate guide today, is get you to differentiate between these models. If we're going to do the work, let's lean towards these three major credit bureaus and evaluate what we find in that realm, as opposed to relying on the Credit Karma score. Credit Karma is largely used for educational purposes. It will have a pretty broad swing one way or the other. So it's hard for us, if we think back about our goal, if our goal is home ownership and we're using that Vantage score, there's probably going to be some shortcomings along the way in doing the work. So as the beginner guide in that theme, I just want to move us away from, not saying it doesn't have any value, but I want to move us back towards the major credit bureaus, because this is where lending decisions are made, and this is where the credit union will also be looking at these models as well. They will not use the Vantage score for lending decisions. So very important as we get started in this work and, you know, thinking about the ultimate guide to understanding credit scoring. This is a key lesson, and I hope you take that away from the lesson today. The difference between the scores from the major bureaus as opposed to the Credit Karma generated score. So this is a great illustration, I think, that makes that point. So if you notice the Equifax Beacon score, and then we've got a couple of scores that are generated by Experian and TransUnion, you'll notice the math's a little different. So we have a little bit different starting point. Equifax scores 300 to 850. That's what we'll be talking about today. All the major bureaus, the three bureaus, will use a similar approach here. So if you look at the factors that we're talking about, there's basically 5 key areas: payment history, outstanding debt, credit history, credit inquiries, and types of credit. And the graphic here kind of gives you a percentage of how that score is broken down. What's the weight that's placed on each one of those variables? And then you also have, you see that the total point value, everyone starts essentially at this 300 baseline. It's a score that I've not seen. I tend to think about it as more hypothetical than it is in terms of, I've never seen one. I'll just put it that way. Most folks, even new folks to credit, if you're new to credit, it's going to take you 6 months to build a credit score. Still would start somewhere above that 300 baseline. But when we think about the score and how it's calculated, the key for us today is to understand that there's 5 factors that make up your score. And I want you to also differentiate between the 3 major bureaus and the scores that they provide. So if you pull one and you say my score is X, you'll notice that because the math's a little different, that score will not be the same within all 3 models. That's one thing that I want you to look at. And then also the similarity just within those factors. So as you're doing the work in payment history, or outstanding debt or building your credit, your credit history through time, this will also influence those other models. So as you're building your credit history through the model that we present today, you're also going to be seeing a score generated positively in the other models. So, but you can look at this graphic and just kind of see how things are broken down. And, really the key factors here, payment history and outstanding debts. We'll work our way through these factors in the time that we have today, but this will provide you a good overview of how the model works and really what's kind of packed into these 5 key areas and how you can use it to build credit and also maybe address any potential hardship that you may have had. So we'll get started on that now. So when we think about scoring, again, those five key factors that we looked at. Payment history. So this is the most important factor in your score. You can see back here that payment history is 193 total points and is 35% of the score. You can refer back later and kind of look at some of these numbers, but top 2 factors is going to be payment history and outstanding debt. So when you think about payment history, there's a lot that's captured into this one factor, this one variable. So of course, we're all familiar with things that are just timely payments. You borrowed a certain amount of money, you make those payments back on time. Well, that becomes part of your payment history. The opposite of that is when you've had some issues along the way. So many of us, it's inevitable that we do. There's things that just happen through life. Life is messy oftentimes. So, but the one thing again that I will point out about the model and just thinking about this, I always say, we want to shift our thinking. Nothing is set in stone, okay? I mean, even with bad score, we can always improve. That's why we have that legal landscape. That's why we have consumer protections. That's why we have education and counseling, and we have a great team at the credit union to work through this process. Basically, what we're looking at is, even if there has been a hardship, there's ways to overcome that hardship. I just want you to keep that in mind. There's always a way to move forward. So when we think about payment history, though, most common example, again, is just going to be timely payments. You borrowed X amount of money, you're paying that back through time. That becomes part of your payment history and helps provide that stability in your score. Thinking about those other things that happen, though, bankruptcies, foreclosures, wage garnishment, civil judgments, I mean, those are kind of the worst case scenario, but even just late payments, that activity all gets captured under payment history. That's really what I'm trying to say. So timely payments, late payments, collection accounts, all of that is part of this payment history factor. So that's why it carries so much weight, so much value. So when we look at, obviously when we're looking at whether building history or maybe our score is stagnant, and you say, well, why is my credit score X, whatever it might be? One thing that we want to look at and get savvy about is an ultimate, understanding of credit, understand the factors and how they function. Why do they function that way? So payment history, big part of that. Accounts that are showing no late payments or negative information, you can see where this factor really covers so much. So we want to make certain that we're timely. We don't want to have things go into some of those situations that are worst case scenario, but there's a time dimension to those things as well. And we always like to think about ways to improve overall payment history if you've had some issues where you've been late, or maybe there's been something more severe that's happened along the way. We can still improve it through time. That's the key that I want you to remember. But payment history, go back, again, after the presentation, and just look at the number of things that get packed into this one factor, and you can see why it's so important. Next thing we'd look at is your overall outstanding debts. Now, this one probably feels familiar to a lot of us, because when we think about credit, oftentimes we say, wow, I'm overextended, or I'm carrying some debt right now. How does that influence my score? Well, if you think about why is your score X, whatever it might be, you're not someone who falls into that situation where you have a lot of late payments, didn't have, something as severe as a wage garnishment or anything like that. Maybe you've just carried some outstanding debt. This too will have a pretty significant impact on your score. So if your score is, maybe stagnant at this point, maybe needs some improvement, and you haven't had some of the issues that are listed under payment history, then we work our way into the model and we start to ask some other questions. What are our outstanding debts and how might that be influencing our overall credit score or credit capacity? So here it's going to look broadly. The only thing here is student loans are not factored the same. Again, thinking about risk. So we're looking at things that either could be discharged through a bankruptcy or go into collections, credit cards, home loans, all those sorts of things carry a large amount of risk. Those debts do get included in this model and are weighted differently than, say, a student loan. But it works in totality, and with credit cards being high risk because they can be discharged through a bankruptcy. So here's a couple things to consider. So when we look at outstanding debts, the general rule is, and I call it the 30% rule. So anytime you're carrying, this is a FICO rule, anything that you carry on a credit card that is beyond 30%. So you take any credit card line of credit, say, just pick a number. You can multiply that times 0.30, 30%. As you go out beyond that 30% threshold, that carries more risk. Why? Because you're more likely to get overextended. You're more likely to have trouble paying off other debts. So you're already in that higher risk category. What happens? Your score starts to drop. That's essentially signaling to those in the market, in the credit market, the account has now reached a point to where it's carrying more risk. So your score starts to diminish through time. You have a lower score. And just the opposite can occur. We've carried some higher debt. We want to pay that down. So as we're moving incrementally back towards 30% and paying off, our score starts to adjust and go back up. So we can see the scoring, our credit score is not stagnant. It will move through time depending on the amount of debt that we hold, and depending on whether or not you're carrying beyond that 30% threshold. Now, it does work in totality, okay? So all credit cards, it looks at everything in the total picture. So it's not focused just on an individual account, but as we're paying down debts, and you'll see this later in the presentation, or just thinking about ways to build credit, that 30% rule is something I have you pay a lot of attention to. Just understand that when we cross that 30% threshold, FICO it basically signals that as we move out towards 100% or being maxed, obviously it becomes more high risk. That is, the likelihood of delinquency or default increases through time. So that's how that functions in the credit scoring market, or the credit market, is it signals to those lenders, banks, others extending credit, high risk. So to improve the score, again, what we do is we shift the credit debt ratio. And that is, we start to reduce those high balances across cards so that we can get our total debt level, our credit debt ratio, below 30%, and then move it on down to zero and really improve our overall credit score and credit capacity. A couple other things about this statute of limitations on debt collection. As I said, I like to be an optimist here. So I know that there are ways to improve, and there's always ways to improve in the credit area. Statute of limitations on debt collection, state of Ohio is 7 years. In most states, it's 7 years. There's not a uniform federal law that states that it has to be 7 years, but in most cases, for debt collection practices, it does tend to go towards 7 years. What that means for us is a couple different things. If you've had some outstanding debts and it hasn't gone, there are times when 7-year statute of limitations means that outstanding debts that were unpaid, you're no longer legally liable to pay that debt. It does fall off the credit report. So oftentimes we'll do a couple different things. We'll work on reducing debts improving payment history, and then some debts will fall off naturally through the statute of limitations. Not saying don't pay your debts. Please understand that is not what I'm saying here. But just in terms of the statute of limitations on debt collection, what that means is that we're not permanently in a bad situation. Again, the way that the scoring model functions and the way that the laws are written, we want the ability to help consumers, borrowers. We have to have access to credit. So we don't want to be permanently penalized for something that may have happened in the past. So there is a statute of limitation on debt collection. We'll get into those other questions later if you have them, but just want to point out that the credit debt ratio and that 30% rule has a great deal of importance when we think about either having a strong score or why your score may have declined through time. Nice graphic here just shows basic utilization and the impact on your score. So basically what you can see is that as you go out, you can see how your score is affected and how credit utilization will impact your overall credit score. Another illustration of the credit debt ratio. So often get questions about, we think about the Ultimate Beginner's Guide. This comes up a lot of times in conversations with folks. You know, how long does information stay on my credit report? You know, I've had some things happen. How does this function? Well, talked about the statute of limitations for debt collection. Well, let's get into a few more details. So I've got it listed here. Just some what I would consider kind of common questions, but very important questions. You know, the good stuff, well, stays there indefinitely. We also think about closed accounts. Often hear about missed payments, charge-off accounts, that is, maybe you opened a card or had a loan that you didn't pay back, it was charged off as bad debt. When does that fall off? Collection accounts. We also look at things from the legal perspective, whether it's bankruptcy at Chapter 7 or 13, and whether we're looking at, you know, foreclosure, other types of inquiries. You know, again, go back and kind of read your way through this slide later on, but it provides a lot of information just about how long. This question often comes up, whether you're building credit or maybe your score, you've had something happen along the way. Again, things are not static. So you'll see that number 7 is there quite a lot because it's that statutory kind of guideline, whether it's collections or charge-offs or just late payments. The most severe consequence is usually bankruptcy because that has the most lasting impact. Anytime something has gone through the legal process, the bankruptcy process, that has the most lasting impact on the score. And, you know, it's also legally where you would find something listed on the credit report for the longest period of time. So, but this gives you some information. Often get those questions about how long will something stay on the credit report. So this gives you a good visual and some good background information as you think about the overall score itself. All right, picking back up on that notion of our credit score and the factors that go into the score itself, we've also got length of credit history. And basically what we're talking about here, just want to go through quickly, don't open and close accounts. And this is where, go back again, where we talked about knowing the goal and really working with General Electric Credit Union. Anytime we go into work, we're looking to either obtain a loan or maybe we've had credit for a few years and we're looking to take another, you know, really take on a larger loan, purchase a home, start a small business, something like that, where we're needing some significant cash to finance something through time. We definitely don't want to get into a place where we're just opening and closing accounts. That will take us in a negative direction. Not only can it shift the credit debt ratio, but in this particular case, you know, it could really penalize you. FICO wants us to have accounts that are open long term, so we don't open and close accounts. Always ask those questions up front with the credit union before making any type of decision to close an account, particularly if you're thinking about borrowing. I see this happen a lot. folks, even where they're 5 points away from obtaining the minimum score that they need, they will close an account out, and then it's a self-inflicted wound. And so your knowledge and what you're learning today, make certain that you ask those questions. FICO tells us the rule, when you close those accounts, it can impact the credit debt ratio. So if you're carrying some outstanding debt and you take something out of the credit debt ratio, it can shift that percentage and make it look like you're carrying more debt. So we have to be cautious about that. So, but length of credit history, you can see that as we work our way through the model, it's still an important factor that I want you to know about. But always work with the credit union if you have questions about accounts that should be, if you're thinking about closing the account or how that will function. Credit inquiries, gonna just talk briefly about this, but there's basically two fundamental types of inquiry, hard and soft inquiry. So the ones I think most folks are familiar with are soft inquiries. So that is for educational businesses. What I mean here is you pull the credit report in some way to look at your score. No impact to your score whatsoever, okay? A hard inquiry is more significant. That is, you're asking someone to loan you money, so they're gonna pull a credit report to make a lending decision. That can have an impact on the score. But the key here is really, again, know what you're aiming at. Have the goal in mind. So if you're just looking to pull a score and you're doing some planning, that's a soft inquiry, no credit impact. But if you're going out and you're looking for lines of credit, essentially, home loan, car loan, or student loan, that falls under this rule called deduplication. I won't get too heavy into that rule, but basically, those are different than just, say, credit cards, personal lines of credit, those sorts of things that can continue to be reported on your credit report through time. So there are some differences about inquiries, but the two big ones that are most commonly understood is whether I'm pulling a score or a business applying for a job or educational purposes, things like that. I just need to know something about the score. That's a soft inquiry. Anytime you're asking for money, that becomes a hard inquiry. So just keep those distinctions in mind. The credit mix, this will be the last factor that we talk about. So basically what we're talking about here is just having, we're thinking about if we're looking to have a strong score, we don't want everything just looking at a credit card. That's, what we call a revolving line of credit. We want some variation in the credit mix, installment lines, a car loan, student loans, anything, installment line, those monthly payments that are paid, revolving lines that can vary in the amount that you owe. Basically, what we're saying is we want some variation in how our score is calculated. Do we have accounts that are some type of mix between a revolving installment type of credit? So this is important, particularly for those who are thinking about home ownership, or maybe even thinking about small business lines of credit. But if you have any questions about how to broaden the credit mix, certainly we've got Rob on the line with us today, and talk about some specific things that you could do through the credit union to maybe help improve the overall credit mix. So guys, that right there is the 5 factors that makes up the score. I'll spend a few minutes just talking about how to get the good stuff going, and then we'll open some things up for questions. When we think about going back again, thinking about the products and services that I've talked about before, secured lines of credit, credit builder lines, personal loans, those sorts of things. I won't get too far in. We just don't have the time today to talk about non-traditional approaches. But if you have any questions about that, I can certainly take those questions even after the call. But I want to focus our time today, whether on products and services. That is, whether it's a secure credit line, credit builder line, or a personal loan. So when we think about building credit, if you're new to credit, and you pull a score and you don't have anything reported on the score, it's going to take us about 6 months to build a line of credit. Oftentimes we don't, if you're new to credit, you don't have a credit score, so we have to use something to get our score started. So we could use a secured credit line. Essentially what we're doing is we're using cash to secure a line of credit, and then that gets reported back as payment history as we use that card. And it also helps establish a line of credit, so that card that we open, a secure credit line, can really be that first step in building a score that we need to establish, credit for a larger loan. So there's some variation there on how to do that, whether it's a secured line or a credit builder line. These are smaller dollar loans that you could obtain through the credit union, or even a small dollar personal line of credit to help build some credit through time. These are things that I would encourage you to speak directly with the credit union about. And also Rob may talk a little bit about those in some of the time that we have. But the key here is that knowing the score, knowing your goal, you want these things to be in alignment. And you also want to work with the credit bureau. You've gotten an understanding of how that model functions and why that model can really help answer questions about why your credit score is either high or low, or ways to maybe improve it. But to take that a step further, we also need some loan products. That is, we need loans or access to a line of credit to either strengthen our overall credit through time, establish credit, or apply for a larger loan to meet our individual or family needs. So this is where I want to encourage you to work, closely with the credit union to talk about those loan products, and then we can work as a team to kind of help you get there. Won't spend a whole lot of time here because we've only got a few minutes left on our call today before we talk about or answer any of your questions. But piggybacking, authorized user, these are some things you can do when we're just trying to generate overall capacity. If you're new to credit, you can also become an authorized user. If someone has, essentially what you're doing is you're piggybacking on someone else's higher credit score. By doing that, it can provide some stability in your score, help you build credit. At the end of the day, while this is a strategy, still the most important thing is for you to follow those steps that we've outlined today, so that you can have that ultimate understanding of how to build credit by knowing that model. That's what's most important. This is a great strategy, but at the end of the day, I really want you to focus on that credit scoring model, so you have a strong score that's built fundamentally around the model that we presented today. The other thing is that in terms of just outstanding debt or shifting that credit debt ratio, okay, if there's anything that I can do to help along the way, Trinity Debt Management, strong partner with the credit union, certainly want to help you there. I want to point out here though, despite just doing debt management and paying down strategy or paying down debts, debt alone, just reducing debt alone, will not help you build your credit. So this, again, my message to you today is this: it takes us paying down debts, but it also takes us utilizing services through the credit union. That is one of those types of loans that we talked about for credit building to really make this work. So yes, we do need to manage debt. We need to reduce our outstanding debts to improve our credit score, but focusing narrowly on debt will not improve your score. You've got to have a strong payment history. We have to have the right financial tools to do that. Oftentimes it can be a secured line or a small business or a small personal line of credit to do some credit building. But just focusing on debt alone will not build the score that we need. So certainly want to be a partner to help you with any kind of debt management that you need. And I can review a credit report and work with folks at General Electric Credit Union to help you get the line of credit that you need or the score that you need. But we want to encourage you again, while paying debts is important, we also need to improve payment history and utilize some small dollar line of credit to build the score that we need through time. And I talk a little bit about this here. I won't, we're running a little short on time, so a couple action steps for you. I'll get to that now. I've talked a little bit about some of the debt repayment strategies. In this particular case, what I want to point out here is this one strategy, since we're a little short on time today, the rollover method. When we're paying down debts, and these are things that I can help you with here at Trinity, oftentimes what we'll do is we will rank order debts from lowest to highest outstanding debt. And we will look at your monthly minimum payments. We try to practice the rollover method. So I've talked about this in terms of consequences. I think it's very motivational to see your debts reduced. It improves the credit score, accelerates debt repayment. I don't have time to get into these various options today with credit utilization and interest rates, but the rollover method in particular, if we want a starting point, this is a great way to accelerate debt repayment. That focuses on that credit debt ratio that we talked about. You can rank order those debts. What this method allows us to do is we basically pay off, if we have 4 cards, we pay off the first one and we roll those funds forward so that we're accelerating debt repayment on card 2, card 3, card 4. And what you'll start to see through here is by utilizing this particular approach, we shift the credit debt ratio and strengthen the overall credit score. So this is our last step, and then we'll take some questions in the time that we have. First of all, I appreciate everyone's time today, and appreciate you being on the call. And I hope that I provided some good background. I could go on for another 2 hours on this topic because I'm so passionate about it, and I really do love talking about credit. So if there's any questions that you have, please feel free to contact me through Trinity Debt Management, and my contact information will be in the presentation today. But I hope that I provided some of that context for how to become savvy about credit and really understand the ultimate guide and how to frame questions around the credit scoring model. I've introduced some strategies to kind of strengthen your score through time, and want to talk just very briefly. I can pull a credit report for you and work with you directly to do some credit building, really provide some strategies to work with you and the credit union to build your score. And the key thing here too is just understand there's a timeline. So if you have a larger purchase in mind that you are looking at, jot that down, understand the goal, contact us here, let us get started so that we can make credit building count for you. We've got a lot of folks that will help you establish the lines of credit that you need or rebuild credit in a way that will get you the loan that you need to meet your personal finance needs. So with that, I will close, but I just want to say thank you again to all those who are on the call today. Hope I've provided a spark of inspiration today about credit and get you motivated. And if you have any questions, I'll take those questions now along with Rob, but please contact me if you have any other questions. I'd be glad to work with you long after the call. So thank you very much. I'll turn things over to you now, Rob.
Thank you again, Todd, and Trinity Debt Management for being a continued value partner for the credit union. As you know, today we discussed credit, ways to build good credit, and even credit rebuilding. As your financial partner, GECU is committed to improving the quality of our members' financial lives. As part of this commitment, General Electric Credit Union has partnered with the Credit Union National Association to certify its team members as certified credit union financial counselors. This nationally recognized accreditation helps equip our certified counselors with tools and resources needed to guide members through financial challenges such as these. Select team members, like myself, have been formally certified to help our members thrive in their financial lives, and this program represents our dedication to expanding the financial service we can offer you throughout every step of your financial journey. Regardless of where you are in your financial journey, we're here to assist you, whether you are opening your first account, saving for the future, buying a home, or planning to retire. We are here to provide informed counsel, refer you to tools, and recommend appropriate products and services to meet your needs. Please know our certified financial counselors are here to guide you through spending wisely, building savings, borrowing responsibly, planning for the future, building financially responsible behaviors to achieve your goals. We're excited to provide these financial counselors like myself at select branches. We're ready to discuss with you when you are ready, so do not hesitate to contact myself or member services, who would be more than happy to connect you with a GECU certified financial counselor near you. And again, thank you for attending the webinar, and I'll turn it over to Kelly.
Wonderful. Thank you, Rob, and thank you, Todd, for taking us through today's presentation. But once again, we hope you have a great rest of your day.